In today's video, we are going to take a look at Realty Income Corporation, which among investors has built a reputation of being one of the best dividend-paying stocks out there on the market. But is this reputation actually justified? Is Realty Income really one of the best REITs out there? And should you invest in Realty Income at its current price levels? This is Might As Well Invest, becoming smart money. On a side note, only a small portion of you that watch my videos are subscribed or smash the like button. So if you end up liking this video, consider doing both of these, as they are free and you can change your mind at any time. Now, enjoy the video. Realty Income Corporation was founded in 1969 and gained its status as the monthly dividend company fairly quickly after its stock listing in 1994. However, it's more than just a monthly dividend payer for many, as the company at the same time also gained a great reputation as a company that even managed to sustain a dividend in the worst of times. But more on all of that later on. For now, let's take a look at the valuation of Realty Income, which currently sits at about $22.8 billion. This, however, obviously does not come from the company's reputation alone, as this can to some extent be attributed to the revenue of the last fiscal year, which for the case of Realty Income sat at about $1.6 billion. But let's break that revenue down a little bit further, so we can get a basic understanding of what may drive Realty Income going forward. Realty Income divides their business into two segments. The biggest one of these is, as one could think, the rents collected, with about $1.6 billion. This is then last but not least followed by other revenue sources with a combined contribution of $12 million to the overall revenue. For all of those that are interested in the revenue portion per tenant, here is a quick list. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders or want to become such, and that are the distributions to shareholders. Realty Income currently returns capital to their shareholders through a dividend. Sadly, the company, however, does not use the second most common form of rewarding its shareholders, which would be doing stock buybacks. However, let's at first talk about the dividend, which at the current point of time sits at about $2.81, equaling a current yield of 4.62%. Like I've already mentioned, Realty Income is known for its long dividend track record, which has been ongoing for over 27 years, with constant dividend hikes. Sadly, these aren't the biggest, with a 5-year growth rate of 3.95%. Yet they do fairly well in outperforming the inflation, with a small but nice bonus on top of it. When it comes to stock buybacks, these are sadly not present at Realty Income, as the company instead rather issues shares in order to fund new properties. While this isn't necessarily bad, it is something to keep in mind, as this can water down the shareholders' equity. However, let's take a look at the numbers. First of all, we are able to spot an awesome funds from operations growth trend, which for the case of REITs works similar to the free cash flow, which I usually use in these videos. If we now put this into contrast with the distributions, these are below our funds from operations, simply due to the fact that Realty Income keeps offering new shares. To however clear some things up, if you put them into contrast with purely the dividend, this would also look sustainable. To however assess the financial position of Realty Income even further, let's take a look at the company's balance sheet. As per usual, let's start out with the year of 2016, in which Realty Income's total assets sat at about $13.1 billion. These were made up by about $6.7 billion in equity, $6.1 billion in financial debt, and $300 million in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is done using Realty Income's debt and its cash position of about $9 million, with which we then can get a net debt of about $6 billion for the year of 2016. If we now compare this to the year of 2020, we can see an increase in total assets to about $20.7 billion. These were made up by about $11 billion in equity, $9.3 billion in financial debt, and $400 million in non-interest paying capital. But now, let's again calculate the net debt just like we did for the year of 2016, this time with a cash position of $8 million though. This time we get a net debt of about $8.5 billion, which is already a somewhat decent increase. But let's also find out how sustainable the debt of Realty Income actually is, and whether the debt has gotten more or less sustainable over the years. This is done using the EBITDA, which after some basic calculations leaves us with a sustainability factor of 6 for the year of 2016 and 8.5 for the year of 2020. While these are quite high, I would still argue that they are alright for a REIT, since the assets are more long-term in nature and cash flow quite well. Alright, so since we now have the financials covered, what we want to do is get the margin of safety in order to determine our personal buy price later on. First of all, I again want to mention the monthly dividend payer status of Realty Income, which is not only a nice perk for their shareholders, but actually a part of their business model. Realty Income uses what is called the net lease model. Here they buy properties and simply rent them out to tenants, which then focus on covering basically all of the costs like property taxes, repairs, and so on. This obviously allows Realty Income to cash flow to the point where they can refinance properties rather quickly or grow their portfolio in general. If we now combine this with the rather huge amount of investors that sign up for the monthly cash flow through dividends, this opportunity of buying new properties by also offering new shares while being almost tax-free due to the REIT distribution policy is even further accelerated. This is also why I personally think Realty Income is somewhat of the light version of owning your own properties in terms of the risk to reward ratio. Therefore, I will be reducing my margin of safety by about 10%. At the end of the day, I however see the biggest upside for Realty Income in the reason why they also have gained their status as an absolute dividend champion. And that is their well diversified and what I personally would call recession-proof tenant portfolio. To just name a few tenants, these are companies such as Dollar General, CVS, Walgreens, and so on. All companies that are rather essential or actually excel in times where people look to budget. Therefore, I would personally call Realty Income a great REIT for downturns as well as bull markets, which is also the reason why I will reduce my margin of safety by another 10%. However, as you can expect, Realty Income also isn't a perfect company either, and has its own problems, which in my opinion definitely have to be mentioned. First of all, I personally don't quite like that Realty Income is leveraged this heavily. While this on its own isn't necessarily something bad, as leveraging in order to buy real estate is not only normal but actually quite smart to some extent. I really dislike the way it is done though, which is at a cost of the shareholder. Yes, issuing new shares is a way of raising capital in a really cheap manner. However, from the perspective of a shareholder, I find it incredibly frustrating to see your equity be watered down. Therefore, I will be adding 5% to my margin of safety. To now get the fair value of Realty Income, we have to take a look at the historic dividend yield. For the past 10 years, this sat at an average of 4.16%, thereby meaning you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of $2.81, a fair price to pay would be $67.54, which would mean with the current share price of $61.18, you would be getting a 9.42% discount. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 4.16% and add my safety margin of 10%. This gives us our target yield of 4.57%, which leaves us with a price to buy the company at of $61.48. To conclude, Realty Income is in my opinion a very well-rounded company. It poses a lot of chances, especially for those investors that are looking at investing into real estate without actually owning it and having the possible headache of it. However, it has to also be said that their rather rapid expansion has come at a cost in the form of debt. While this at the current point of time isn't necessarily something to worry about, I would definitely keep it in mind as there is the possibility for it to go south. Overall though, I would really call Realty Income a true dividend champion and really also one of the best dividend companies in terms of cash flow. Realty Income is a very well-rounded company with a portfolio that has a fairly bright future. Therefore, I would currently rate Realty Income a buy up to its fair price or more so personal buy price.